Let's talk about volatility halts, right? So yesterday, if you're not on the free email list, you may have missed it. So we'll talk about it a little bit in this video. We had a trade in this QMMM insanity, and it halted a lot throughout the day. And some of our users, anyway, were in it, and were kind of asking me about, why do these things halt? What's going on here? Is it something nefarious or something like that? And I just realized that I'm an old man. There's not a lot of traders out there like me that are around that may not remember why we did this rule. So a little bit of a history lesson, a little bit of talk about these halts and what you can and cannot do to deal with them. And it starts here as always. If you aren't signed up, you can grab the free newsletter right here. You can also do the free intro to trading course and trading plan course, and those get you onto the list as well. But what I want to talk about is, again, these halts. So we go Q, MMM. So the trade we took yesterday was all based off of a buy that we got kind of right here around 950. That was sent out to users that morning, right? We knew the morning of that if it hit that price, we were going to buy. It's not like, I'm one of the bragging after the fact, oh, look at this wicked trade we had. I'd like to say that I held it all the way up. I chickened out kind of in the 50s, the 40s or the 50s right here. Said, oh, well, that's got to be crazy. Can't go higher than that. And then it shot to 300. So that was my bad for interfering with my system. However, it was still an amazing trade. I know some people got a little bit more than that, just like nuts, like, for high to low, 3,000% move. Just absolutely ridiculous. But if you look at it, you can see all along the way, you get these gaps. And these, if you go into a 1 minute chart and a smaller chart, even into a second chart, gets even more pronounced. So the stock moves and then it halts. It did it on the way down here. Anytime you see a gap between these candles, it means it did it on the way down there, and then it also did it on the way back up. So it halts on the way down, halts on the way back up. It's trading today, and it's doing a lot of the same stuff where it halting every time you see a gap here in these candles, it's because it's halting there as well. So what are these? Why are we doing them? I'm not going to go into like the nitty specific rules of each one. You can Google those and you can look those up. But this is the reason. So if people were not here for, I believe this was around 2010, this is the actual Dow Jones Industrial Average. And you can see at one point during this particular day, it crashed down 10%. Now, a big move in the S&P 500, a huge move, if we go to the SPY and we go to the 1 day, when things were going absolutely insane here, right? This was probably the biggest day I saw down in a while, and it was around 7% or so. But it's a little different because it sold off all day kind of gradually, and we kind of knew why. There was a news event with the tariffs. There was a reason for it. On this day, when I remember vividly, I was working in hedge fund space then, nobody knew what was going on. No one knew what was happening this day. There was no idea of why the market was selling. And this happened, and everyone's like looking for terrorist attacks or natural disasters or all sorts of craziness that could have caused this potential down move. And just had no idea what was happening. It was pure panic, pure pandemonium when people looked at the news and said, hey, there's really nothing going on here that we know about. There's been no assassination attempt or terrorist attack or anything crazy. We closed down 3% on the day. So huge bounce from there. But this sell-off actually took place. This wasn't a bad tick or anything like that. So what ended up happening is somebody at a prop desk at a large firm somewhere, a trading desk, a hedge fund, something like that, put too much of zeros on a trade and hit a button. And that caused this initial kind of sell-off. And then from there, stop losses were triggered. Craziness was going on. Again, people didn't know if the world was coming to an end, if a war broke out, what was happening. So people were panic selling. And imagine being your typical kind of, I have a full-time job, I have a couple of trades on. Again, this is the Dow. This isn't any crazy stock. This is the largest, slowest index that's out there. And all of a sudden it drops 10%. You come back and you're stopped out somewhere around here, and the market had a 3% down day. It wasn't a crazy down day at all. So this caused a lot of conversation, people shouting back and forth and trying to figure out rules that you could put in place to stop this. And what was decided on, for better or worse, and I'll leave the interpretation of this up to you, was halts. If a stock or an index moved too much in one direction, too fast, they stop it and they pause it for 5 minutes, and then it goes to 15 minutes. Again, we're not going to go into all the nitty-gritty detail, but the point of it was to give everybody a break, to give everyone a breather. The idea is maybe if this thing had just sold off and then halted and everyone got a chance to look and say, okay, there's nothing crazy going on. I'm not seeing anything on the news. This is probably just a large order that was put through incorrectly or something to that effect. This whole craziness that happened a couple times since then could stop, because a couple things were happening when it was selling off. One was because no one knew what was happening. There was a lot of bids that were just pulled. There was a lot of trading systems that were turned off. So there was just no support. No one was willing to buy because they didn't know what was happening. If you halted, you paused, everyone took a break, took a breath for a second, then the idea is you give people time to gather their information and say, okay, nothing crazy is going on. I'll leave my buy systems on. I'll leave my market maker bots. I'll still be able to make markets and to make trades. And you would avoid this, which was, billions and billions and billions of dollars of market cap loss for kind of absolutely no reason. So what happened was these volatility halts, and they simply say if your stock moves more than X amount in Y period of time, we shut her down for 5 minutes. Now, that's the rule. That's why they built them. Now, the problem is pretty obvious here, is that when the stock is halted, you can't get into or out of any positions. It's halted. It's like it's closed for the day. And that can be really problematic for people who are potentially shorting low float winners. Like some of these halts don't look that bad, but just from here to here is a 50% up move. And then from there to the top, if you didn't get in, this candle was open for like 5 seconds. That was 100% gain. So across these 3 candles where it just halts and opens up and halts and opens up, if you were short in through here, that's 150% of your money just in this little tiny part of this action right here. So this becomes a different risk as a trader that I want you to think of. If you are building systems and you are building ideas to short these low float stocks, I'm not going to try to stop you. I'm not going to say it's a bad idea. You just have to know that there's going to be a period of time where you're going to be in something like this that's going to halt. Of course, right, when we were long this, almost immediately we got triggered in. The entry order was like 950. It went all the way to 830, so there's a lot of time to get in, and then it halted almost immediately. So almost immediately we're in for a halt, and this thing, right, halted a couple times on the way up. Again, I chickened out around here. I really wish I just wasn't paying attention at that time. And you could see that it's stressful because you don't know when it's going to open, where it's going to open. And you can see specifically if you're short, that's going to cause sometimes these surges higher because you have a bunch of people who shorted, then it halted, and it reopens, and either they are trying to get out of their position or their broker is force liquidating them, which is, I think, what happened in a lot of this scenario. They're liquidating them out of that position, and that's going to cause this buying, and it causes another halt. So I think the point of this and the idea that I wanted to talk about is I hear a lot of people think that these are malicious rules to punish retail traders or something like that. I don't believe that's the case. I believe it's like a lot of things that happen in the world and a lot of things that happen, especially from government bodies, in which it was built for a reason that makes sense, right? We can't have the entire world economy collapsing because some dude somewhere put an extra zero in on a trade. That makes perfect sense. But then poorly implemented, where this crazy stock probably wouldn't have done what it did if it didn't halt and then open up and then halt and open up, because that would give people who are trading it and people who are shorted, just they're able to put out stop losses. Maybe they get stopped on the position, they moved on. What happens when it halts is it's going to cluster all the sell orders around one particular place. And that's, again, not ideally what we're looking to get. So that's the reason behind why these halts exist. Again, it's up to you whether to believe they're good rules or bad. I believe that the spirit makes sense. I don't think the implementation is very good. I think maybe if it's under a certain market cap, you let it go. I see these rules happen for on particular markets, on especially indices, on large markets, things like that, giving people chances to do that. But let QMMM, which who knows what they do before they were a crypto treasury, let it go and let's see how the market actually reacts to it. But more importantly than just understanding why they are and what they are, I just want you guys to know that it exists. Now, there's certain things you can do on platforms that will tell you where the halt prices are, games like that. The only thing you can really do, because it can move so fast to halt price, there's nothing you can do. The only thing you can do is manage position size. So that's really the takeaway. The synopsis here I want you to look at is an old trading saying that risk is managed on order entry, because you don't know if it's a swing trade. You don't know if they're going to report something amazing or something awful overnight. If it's a day trade, you know now that these things can halt and then gap through stock prices. Rare occurrence, but it can happen, in which companies actually call the exchanges to halt their own stock because they have a big news event that they want to do intraday. Again, very rare now, but it can happen. If Tim Apple called the NASDAQ and said, listen, we're going to launch something crazy, or iPhones have started to explode, please halt our stock while we do a press release, you're in it. So the only way you can really deal with risk in these scenarios is make sure you're sizing accordingly. Make sure that if a stock goes to zero, or a stock doubles or triples, that you are not left completely done with trading. It's the only thing you can do. Again, size down. You generally want to be trading, I think, a little bit smaller than you think, so that you can let real good trades run, and that you have a plan and you have a situation for when these things occur, because at some point you're going to be caught in them. So I hope this helps. I hope this kind of helps calmly explain what these are and what we're trying to do with them. Again, if you like this kind of content, going up at StatsEdgeTrading, sign up for the free trading courses, the free email list, give a like, give a comment. Let me know below. What do you think of these halt rules? How do you think that potentially they could do them differently? Maybe someday I'll be able to talk to somebody who can make a difference here. Talk to you guys soon.